from our perspective, yeah, we think it's going to be tough slugging. And that's just largely because a couple of things. Number one, you're coming from a high base already. Stocks are not cheap. Second, you are going through some big changes in how governments run, government spending, rolling over of debt. And then you've got this tariff situation and the uncertainty that that's creating in the marketplace. So you put all that together, our view is, yeah, it's our noses are down. We're working hard. We're really trying to ferret out good companies. And we've identified companies we would love to own if they fall another 20 or 30%. And we think that's quite possible, especially in some of the tech sector.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart. Today, we're joined by Jonathan Wellum, founder and CEO of Rocklinc Investment Partners. This is Thoughtful Money's endorsed financial advisory firm up in Canada. I thought it would be great to have Jonathan join us. One, because we like to have him regularly on the show. He's a great mind, and obviously, we like to bring in a Canadian perspective for our Canadian viewers, of which we have many here at Thoughtful Money. But also, it's very timely, right? Given the tariffs, the revised trade negotiations between our countries, and the fact that tomorrow is Liberation Day, as Trump calls it. I'm sure it's probably called something different in Canada. I'm sure they've got different choice words for it. But we really would like to get a sense, kind of a boots on the ground sense from Jonathan, what's going on in Canada, get the Canadian point of view, on these increased trade frictions between America and the rest of the world. So Jonathan, thanks so much for joining us.
Good to be with you here, Adam, and from the 51st state. So maybe we'll be part of the U.S. We'll see, eh?
All right. I know you say that tongue in cheek before you get flamed by all the Canadians in the comments section here. Well, look, Jonathan, I got a lot of questions for you about what's going on. Like I said, this is very topical. You're also a very topical guest because we're very volatile markets right now, as we expected going into the year. Would love to hear how you and your team at Rocklinc are navigating those for your clients. But also, I know that a sector that you have a substantial stake in at Rocklinc is the precious metals sector, and that sector is really catching fire as of late. And would love to get your thoughts on that too. But why don't we start with the discussion at hand? I guess first, let's go high level. What is your current assessment of the global economy and financial markets?
Yeah, I think if I were to summarize it, I'd say a pressure cooker. Yeah, I think it's really a pressure cooker from our perspective as we look out there in the world. So we are very careful, conservative. We think that there's just a lot of pressures in the world which are going to make it harder for the capital markets to make a lot of progress this year. And we've had that view now for some time coming into this year. And that's because when we look around the world, we look over in Europe, you see that there's very little growth. You see that could continue to follow a lot of green policies, and energy costs are high and so forth. The U.S. tariff situation, again, the uncertainty in regards to that, to the extent that the U.S. benefits from the tariff, that has to come at a cost of other nations. I think Europe is vulnerable when it comes to some of the tariff challenges that Donald Trump's introducing. The U.S. pulling military support out of Europe. I mean, now Europe is going to have to look after themselves a little bit more, similar to the pressure we see here also in Canada. That's going to cost money. The demographic challenges there, and so on. So I think Europe, when we look at the European situation, very slow growth, if anything. They really haven't grown much for some time. Very similar to the Canadian situation, largely driven by high taxation, regulations, bad policies. China is, as many of your guests come on and talk about, we don't focus a lot on China, but there's a tremendous amount of challenges there. Debt problems, massive misallocation of capital over the last number of years because of a communist regime and not a free market. The tariffs also putting pressure on China, not a huge amount, but again, just slowing things, making things a little bit more, creating more friction. The demographic collapse in China also is something that they can't get away from. Japan, the same thing, not a lot of growth down there. Again, a lot of trade frictions, exporters, that's going to be impacted again by some of these tariffs that Trump is putting on. And so we look around the world, we don't really see a lot of enthusiasm in terms of economic growth and dynamics. And so it really gets, for us, when we look at the U.S., which is, of course, south of our border there, and a very important country, and now run by Donald Trump, which obviously is causing some friction up here in Canada. But when we look at the policies that Donald Trump's putting into place, and I've said this also on previous programs. They're very sound policies by and large. They're very bombastic in how he introduces them sometimes, and his personality, I think, gets in the way. But lower taxes, lower regulations, bringing capital back to your country, trying to reindustrialize, reverse a lot of the policies of the last 40 years that were driven by the World Trade Organization and a lot of outsourcing to countries with cheaper labor and so on. All of that, I think, will bode well for the U.S. economy over time. Clearly, though, for the next little while, there's going to be big adjustments. Even with Doge, I mean, Doge, I think, is brilliant. I mean, every government in the world needs Doge because of the corruption, the waste, and fraud that goes on in government spending. But that is going to result in jobs being lost, a slowdown in some of the government spending, which is great long term because you don't want government spending to be driving the economies. But again, it's going to put pressure. And I think, again, all of these things will slow down growth, and we're going to have to realign some of the growth that's taking place in our economy. Up here in Canada, it's been very difficult. I mean, we've had virtually no economic growth on a per capita basis over the last 9 years. We've had policies that are dreadful. Our Liberal government, again, more taxation, carbon taxes, high regulation, chasing capital out of our resource sector, just heavy-handed policies right across the board. And now we've got friction with the United States. And so, yeah, we're really feeling it up here, and I think there's no question we could quite likely go into a recession. And so, again, when I put all of that together, that's what gives me a more cautious approach from a macro perspective. But again, we zero in on companies. So what we do is we look at that macro, and then we zero down on companies and say, can we find businesses that can navigate these challenges, can continue to grow, and deliver the results, and can we buy them at reasonable prices? And that's really what we're focusing on. Although, as we've talked about before, we are carrying about 25 to 30% cash in our portfolios, which is a little bit on the higher side, and that's because we do want powder dry so that we can move quickly and be opportunistic in terms of the marketplace. So that's just a quick and dirty overview, a quick overview of sort of the global situation and some of the challenges that we're facing.
Okay, I want to dig into a bunch of things you just mentioned there. From a high level view, when you look at that macro situation you just described and the volatility that we've seen so far in markets, and actually the weakness that we've seen so far in markets, at least over the past month, do you expect the markets to continue to struggle as the year goes on too?
That's what we're planning. I mean, we're investing in companies that will be resilient, and I think the secular growth in those businesses hopefully can trump slow growth in the economy. But as I've stated, at the beginning of the year, it's interesting. You can get policies that are quite economically friendly, like some of the Trump policies. It doesn't necessarily mean the stock market's going to go up if it's already at a high base already. And if there's interference in the marketplace or changes that are a little bit disconcerting to people. So from our perspective, yeah, we think it's going to be tough slugging. And that's just largely because a couple of things. Number one, you're coming from a high base already. Stocks are not cheap. Second, you are going through some big changes in how governments run, government spending, rolling over of debt. And then you've got this tariff situation and the uncertainty that that's creating in the marketplace. So you put all that together, our view is, yeah, our noses are down. We're working hard. We're really trying to ferret out good companies. And we've identified companies we would love to own if they fall another 20 or 30%. And we think that's quite possible, especially in some of the tech sector.
Okay. And that's sort of where I was going with this, which is, if I'm hearing you correctly, sounds like what you're saying is this is sort of a time to prepare for stormy waters, which is one, why you've got a higher percentage than usual of dry capital. You want to hold companies in your portfolio that you think can weather the storm. Now, they might not go up in the near term, but they're companies you're holding for the long term that you think will survive the rougher waters okay. So I'm guessing you're not like buying aggressively right now. You're more kind of holding on to quality. But as you just said there at the end, sounds like you say this is a time to really do your homework and really find the great companies you'd love to own at a fair price, and then just be ready and waiting so that if you do have a down year here and it brings those valuations into your target zone, you're poised to act. Did I capture that correctly?
That's exactly right. Because our investment style is to own 20 to 25 companies. So we're not buying index funds, we're not buying ETFs. And so you take a company that we've been watching for some time. We did not, we nibbled a little bit back in 2018, 2019, took money off the table. But a company that we would like to own, someone like a Service Now, for example, we think it's a very powerful business, very powerful franchise. But at $1,150, it's incredibly expensive. Today, it's trading at $780. That gets down to $600. That becomes all of a sudden on a free cash flow yield and on a multiple basis very attractive. And so you can see these big swings taking place in the marketplace, and that's not out of the question from our perspective. So that's what we're zeroing in on. At the same time, we don't want to pretend like we can just time the market. We're not timers of the market. We don't know where the market's going to go in the next month or two, but we look at it and we want to again have reserves and go on business valuation. So we'll have other companies like we own Markel Insurance, which is a fantastic insurance franchise, trading below what we believe is its intrinsic value, quite a bit below, but very conservative in the insurance business. It also has big bond portfolios. So if interest rates continue to come down, they get a lift on their investment portfolios. They're very astute equity investors. And it's a great place to hang out when the market's a little choppy. And so that's the way we're looking at it. We always want to have a couple oars in the water, though. We want to be able to make money. So last year, we did very well. We were, largely over 20%. This year, we're still positive in the year, despite the fact that we've got a lot of money invested. But it's again where we're invested in some of the defensive areas, and as you mentioned, gold and silver, of course, have done a lot of heavy lifting this year for us, and we appreciate that. Yeah.
Okay. I just want to note for folks, your approach is very different from, I think, many regular retail investor approaches over the past decade, which was sort of the passive trade, right? I'm just going to buy and hold. I'm just going to kind of own the sector ETFs more or less. I'm going to just buy every dip and just let the upward, inexorable rise of the market take care of me. We've had a lot of people saying, look, those days are likely over, at least for this year and maybe for several years to come. And it's going to require a different playbook. A lot of people have said much more active playbook. I really see Rocklinc as a very active investing organization because you don't play these generalities. You're not buying sector ETFs, et cetera. You are buying, as you said, you like to have sort of 20 to 25 specific companies. You're doing your deep dive homework on each one of them. To me, it feels very much like a Warren Buffett approach. Yeah. Probably the difference is that Buffett actually has the ability to change the fortunes of the companies that he invests in because he can replace management and he can have his other portfolio companies help out. I'm sure you'd love to do that if you could, but still, you are creating your basket of sort of the best, and then actively managing that based upon the prospects and what happens in the market along the way. I've got that correct, right?
You're dead on. That's exactly the case. Yeah, we would be very much Buffett-like. I mean, I have tremendous admiration for Warren Buffett, and I've probably been down to about 16 of his annual meetings over the years, and haven't been down to them recently. But again, I think he's one of the greatest investors of all time, and so you could learn from far worse people. Yeah, he's really shown that discipline and focus and fundamental analysis does work over time, and he's done a phenomenal job.
Okay. All right. Well, look, let me get back to the macro side of things. One of the questions I had here for you is what was sort of your general assessment of the economic agenda of the Trump 2 administration? I think you've already answered that at a high level, where it sounds like you actually think in general their policies are pretty good. Growth oriented, will likely lead to higher economic growth in the future. But if I heard you correctly, which echoes a lot of what the guests here say, but we may have some tough sledding before we enjoy the fruits of those policies. One, because the policies by themselves are disruptive, and you're going to have, as you dismantle the old regime and build a new one, you're going to have, a period of detox, I think, as Treasury Secretary Scott Bessent called it. So let me ask you this.
Well,
I
and
went
you have
through.
to
Oh, go
you have
ahead.
to you have to convince companies that I mean, there's a lot of capital going into the business, but if you listen to some of the CEOs, I was listening to the CEO of Alcoa again, caught up in the aluminum tariffs and so on, but he was saying, look, it's very difficult for us to allocate billions of dollars of capital just based upon tariffs. We have to know that this is going to be long-term policy.
Right.
And so it is difficult for these companies to allocate and know, if there's going to change in government in a few years and all of a sudden the tariffs change. They've allocated based upon a bit of a false model. So it's tough. It's tough for the CEOs of these large companies to know exactly how do they allocate that capital. Yeah.
All right. So you're taking exactly where I want to take it. And obviously, that uncertainty is manifesting in a lot of heartburn in the markets right now because the markets price off of certainty and they don't have a lot of certainty to price off of right now. So if I can, let's just talk about each of kind of the main pillars of the economic agenda: tariffs, tax cuts, deregulation, DOGE, and deportations. Um, so on tariffs, how I know I'm asking you to kind of put on the U.S. hat here for a moment, but how likely do you think tariffs, or at least the threat of tariffs as a negotiating tool, are likely to work, um, for Trump here to kind of get the outcomes he want? Do you think it's going to be an effective tool, or as some are saying, could this blow up in our face? Are we burning bridges with lifelong allies and doing irreparable damage?
Yeah, it's a good question. I mean, I think I think the general idea of fair trade is a very good one. So you go to the general principle that, okay, the tariffs, generally speaking, have been higher in other countries and have made it difficult for the US to go into some of these other countries where it's been very easy for countries to go into the US market. And I think that's generally the case. And should that continue, 50, now we're talking, 70 years after World War II, when the U.S., a lot of those tariffs were, the tariff situation was there to help rebuild countries and so forth. Well, I think that's long gone. I think the U.S., I think Donald Trump has acknowledged that the U.S. is financially in very, very bad conditions, very bad shape. And so the current model can't continue. I mean, Adam, I think that's the bottom line with the Trump regime and his leaders, that $2 trillion plus of deficits, 36, 37 trillion dollars in debt, 100 to who knows how many trillions of 100 unfunded liabilities is not sustainable. So something has to change. And so I do think that putting some tariffs and using tariffs to get fair trade, and so more opportunities for the U.S. to sell into other countries, whether it's automobiles or other high-tech equipment and so forth, that makes sense. The issue is on the execution and how you're going to pull that off. And I think that just by throwing on large numbers and threatening people and not really having a spreadsheet and sitting down and working with the countries and negotiating, I don't think that's the ultimate strategy. But the general idea of fair trade and free trade, which really doesn't take place in the world as we know, trying to get to a free trade base, I think that is a good idea, and that would advantage the U.S. because it is a powerful country, it has the deepest capital markets, it has very creative people, it can attract the best talent. I think that does bode well for the U.S. market, and it's not as lethargic and regulated, dominated as you have in Europe or in other parts of the world. So I think the tariff situation is fine, but it depends on how far he takes it. And if he just continues to use it as a blunt instrument, I think that could backfire. And I think you're getting a bit of that now. I mean, every time he turns around, he doesn't like something, he says he's going to throw tariffs on people. I think that will again wear thin over time. But so to answer your question, I think yes, it can work, but it's all in the execution, and trying to do it with a little bit more finesse, I think, would be helpful.
Okay. So a couple questions there. I guess the first is, you laid out, I think, an understandable rationale for them. Essentially, America's kind of been getting a bad deal, been subsidizing a lot of companies with countries, because the tariffs weren't a lot of tariffs against America. America wasn't really doing the same. Um, of course, as a status quo persists, an entire power structure grows around it that feeds off of it, and so it doesn't like change, right?
Mm.
It's hard I feel bad asking you to sort of speak for a country, but as one of the countries on the receiving end of this, do Canadians say, yeah, all right, I get that, we've had a good deal and we're going to have to give up something, or is it more outrage, like, wait a minute, this is, we, we the status quo is just fine for us, and you guys are jerks for trying to change it.
Yeah, with the Canadian situation, it's a little different, I think, than Europe and Japan and India and so forth. Is with Canada, we actually had a trade agreement. So we've gone through a number of trade agreements. So you had NAFTA, the North America Free Trade Agreement, and then that was updated, if you will, by the U.S. Mexico-Canada agreement by Trump himself back in 2018. So we had a rather detailed trading arrangement with the United States. So I think the changing that without actually going back to the negotiating table and opening that up in a more of an official way, it does come up, I think, next year anyway, normally. But I think the way Donald Trump has dealt with the tariff situation has definitely led to more outrage in Canada rather than, okay, he's got some good points. And so I think that's the unfortunate part about it. We actually have a really detailed trading arrangement with the U.S. that he said was the best deal that took place that he's ever done back in 2018. He was bragging about it, and then to turn that over and attack it, I think has been unfair. Now he's raised some issues. The problem is he colors so much in with the tariff issues. He talks about the border, he talks about drugs, and all of these other issues, and there is some legitimacy to some of those issues when it comes to Canada. We need to do a better job with our borders and our immigration. We haven't not, the Trudeau government has not done a good job there, our Liberal government, similar to your Democratic government with the southern border. And we've also had a drug problem in our country. So we've had China bringing drugs into Canada through the port in Vancouver, and that has caused some issues. It's not just a border. People say, oh, well, there's not much gets across the border, but a lot gets through the logistics and into the States. And I think that's obviously irritated the Trump regime there, the Trump administration. One of the most difficult aspects of, again, dealing with the whole tariff situation with Canada is that we have an established agreement, the USMCA, and then that's an issue that we can renegotiate, sit down, talk about it, go through the details of that. But what Donald Trump also does is he tends to mix in some of these other factors like borders and drugs and all of that, and he uses those as a bit of a wedge also. And I think it would just be more productive to actually get down to the specific issues. What are the irritants? How can we work better together and be more transparent about it? And that would be, I think, a much better way of going about the whole transactions. The way he's gone about it, I think, has created a lot of angst within the Canadian population, and for good reason. It's going to upset a number of our industries. And so people are somewhat outraged in Canada in general in terms of what's happening.
Okay, so obviously there's the worries of the upheaval, right? But it sounds like you're saying there's also maybe a sense of betrayal, like, hey, we negotiated our current agreement with you in your first administration, and all of a sudden you're coming around and telling us that we're somehow screwing you when we all agreed, 5 years ago this was a great deal. True?
Yeah, and when you consider the size of our trade, it's almost $1 trillion back and forth. It's a massive amount of trade, especially for a smaller country like ours in comparison to the U.S. And when you actually look at the trade deficit, it's not that large given the size of trade. And he throws it around and makes it sound like a large number. But a lot of the reason for the trade deficit is because we export to you and you buy from us a lot of natural resources. Okay, so you're talking 4, 5, even up to 6 million barrels of oil a day. You actually buy that at a subsidized price. You buy that below the world trade, the WTI price, because we're landlocked and it's certain, it's heavy oil. It can only go into the refineries that are in the U.S. You buy a lot of uranium, potash, aluminums. So there's a lot of materials that you buy from us that you can actually turn into value-added products. So I would argue that trade deficit is really quite small, and Canadians actually buy a lot of things from the U.S. and spend a lot of time in the U.S. on vacations and tours and so forth. So I think some of that, frustrates Canadians also, because we really, I don't think are actually taking advantage of the U.S. I think it's actually a pretty good trade arrangement. Doesn't mean it can't be better. Doesn't mean there aren't things that can't be fine-tuned, but let's sit down and talk about them.
Yeah, well, look, I'm not trying to provide any air cover, and I'm just guesstimating. But I wonder if part of this isn't, one classic Trump. And again, I've heard him describe his preferred negotiating style, which is, when I enter a negotiation, what I like to do before I enter the room is crack open the door, toss in a grenade, shut the door, wait for it to go off, and then walk in, right? So he likes to put the other party on their back heels from day one. And some might say, yeah, but I mean, we're like a good ally of yours. Why would you do this to us, right? And again, totally postulating here and not condoning it necessarily. But what he might be doing is it's to prove a point, right? Which is to show the rest of the world, hey, look, if I'm willing to do this to my closest trading ally, you better be damn sure that when I threaten you, a country that I've got less close ties with, trade penalties or whatnot, I'm going to deliver on it because I'm playing hardball with my best buddy over here. Again, not condoning it, but I'm just wondering if that is part of a strategy.
I think that is the case. I mean, certainly I've talked to our clients. I say, listen, just take a deep breath and step back here. It's not over, and I think you have to be careful that you don't get overly concerned about it. We need to be concerned. We need to focus on it. Don't get me wrong, but that is a bit of the Trump style. Now, having said that, it has sharpened up, I think, some of the Canadian policies. Now we need a change in government. We're going through an election right now, and hopefully we do get a change in government to a conservative government. They would be much more proactive, but Canadians are more focused on Canadian goods. They are more focused on maybe getting pipelines to each of our coasts, if you can believe it. I know this is probably hard for the Americans to understand, but we have all that oil sitting in the middle of our country, and it's an awful lot of oil, a lot more than the US has. But it's landlocked. We can only pipeline it into the United States. We haven't been able to get the policies and regulations, so we actually have pipelines to Vancouver or the West Coast or the East Coast. So we actually import oil into our country from Nigeria, Saudi Arabia, different places in the world to subsidize our need for oil when we've got the third largest oil reserve in the world. So we've done some very stupid things to ourselves, and we have a lot of interprovincial barriers similar to your states that make it very hard for us to trade within our own provinces. It's easier to go to the United States. So there's a number of things that we need to fix, including bringing more capital into our country, and those now are becoming priorities in Canada. So I'm very optimistic that we will get some substantial changes in Canada, and so for that we could thank Donald Trump that he's ignited a lot more patriotism in our country and maybe unifying us to be a little more competitive, and that'll be better for the US too, and it'll be better for us. It's always better to be stronger than weaker. And Trump knows that we're a little weaker than we should be because we've been very poorly governed for the last 10 years.
Okay, well, and as you said, you've got an election coming up, so it'll be interesting to see how that plays out and what type of reforms the public is going to demand of the elected officials there. All right, so last point on tariffs before we move on. Now, obviously, the uncertainty amongst the tariff wars, as these are getting labeled, is something the markets do not seem to like. And as you said earlier, not only is it hard for the CEOs to determine what capital investments to make if they don't know how permanent these are, what the future is going to look like. It's doubly hard for analysts to make their earnings projections on these companies because they have no idea, right? So obviously and understandably, the markets have had some heartburn over this, as I said. I guess, what are your expectations from here? I know we don't know, but what are you preparing for this to be a prolonged, protracted period of uncertainty, or do you think more like, well, in the next couple of months, a lot of the dust will settle, and the guys who actually get the trade deals done, not Trump, but the guys that sit down at tables and close rooms, they'll iron out the details.
It's a very good question, Adam. So I step back and I say, Trump's been talking about tariffs for 40 years, right? I mean, this is not new for Trump, and this is something that I think he's fairly committed to. So we're taking the position that he's going to dig in for the long term. I know that there's going to be a lot of pressure for him to back off, but I mean, they have created this external revenue, service, and he has talked about lowering taxes and bringing more money in from tariffs. So when we hear all of that, I don't know if it's just rhetoric. I think they are fundamentally trying to change the revenue model somewhat in the United States. I mean, they talk about this as, again, I'm looking at it from outside of the United States, that if you want access to our market, you're basically going to pay a toll to get into our market. And that's what they're talking about. So I look at that and I go, I think that they're serious about this. And so, we as in Canada and other countries, I think we need to take it seriously in how we're going to compete in the United States. And that might mean, and of course, this is what Donald Trump wants. If you want to sell in the States, then you have to produce in the States and you have to provide your service in the States, from the States. And so I'm taking him more seriously. Now, it's been bombastic, the introduction of these tariffs, and he's gone back and forth, and you're getting a headache. You're feeling like you're watching a tennis match. But I think after all said and done, he's looking at a permanent change on funding the U.S. government. And if that's the case, then I think companies are going to have to take this seriously, and it will cause a dislocation. The issue, as we all know in the capital markets, is that's a major change. If the US, which is the biggest, most powerful country in the world and has the most dynamic economy, is changing its revenue model, that is going to have an impact on the rest of the world. And so I just don't know how far he's going to take it, but they seem pretty convinced that this is the way to go. And so that's why we're hunkering down, and gold, silver, and some other great businesses that are least affected. I mean, we don't own a lot of auto parts companies and auto firms. Maybe there'll be a time when those will become quite cheap, but they're caught in the crossfire. Just using them as an example, and it's not going to be pretty if they continue forging ahead. So to answer your question, I think they're serious about trying to change the revenue model somewhat on how taxation is gathered. Can they do that and sustain that through another administration, let alone through the next number of years? I guess time will tell. I'm not sure about that, Adam.
That's a great way to put it, trying to change the revenue model of the US. And the more I have listened to the new administration, that really does sort of ring true, right? They're to your point, they're trying to really kind of shift the burden of the tax receipts from US citizens and US companies to the foreign players that want to do business in our market. Presumably, that's sort of the way that it kind of worked, I think, from what I've heard in the 1800s. So it's not like it's something that's never been done before. And I've read it several times recently on this program, so I won't go through the whole list again, but like it does seem to be working a bit. I mean, we've had some pretty big commitments of capital coming from nations and really large companies. Doing this from memory, but I think it was United Arab Emirates has committed like 1.4 trillion. Saudi Arabia, I think, has committed something like 600 billion. Apple's committed 500 billion, Nvidia 100 billion, and a bunch more down the line. So, they're doing what he's a deal maker. Trump's a deal maker, right? He's trying to get these companies to say, all right, look, if I commit to making stuff in your country or reshoring these jobs, whatever, hopefully you're not going to ding me, with these punitive tariffs and whatnot. So that seems to be working, and they're doing other things too. Some big, some small.
Yeah, and part of that, Adam, I think also is that he's looking at the world quite differently. Look, he sees China as the major threat. They sees them as a major threat. And he also says, look, can we actually, U.S. be the global policeman? And why do we have troops on the ground in Germany, for example? And so he's questioning a lot of the modus operandi that's been going on for decades. And a lot of the questioning, I think, is actually pretty good. I mean, why is the U.S. funding all of this around the world and so forth? And if China is the threat, then do you want to have supply chain issues into your country? Do you want to control your steel and your aluminum? And so when you're making weapons and planes and so forth, you're not dependent on other countries. I mean, there's a tremendous amount of rationale behind what Trump and his administration are doing. It makes a lot of sense. I want to control my borders. I want Greenland that's a vulnerability. So we go after Greenland. Canada can be a vulnerability to the United States because we're sitting above you and we've got massive border and we don't have sufficient military and so on. So these are real issues. And I think, it's just that they're going at so many things so quickly that I think it's hard to get your mind around all of it.
Well, it's overwhelming and it's destabilizing and it creates a lot of uncertainty. But I'm glad you brought that up. And look, neither you nor I, certainly not I, are geopolitical experts. But to the point you just made there, it seems that one of the potential strategies, right, versus globalization and America's World Comp and all that stuff is a okay, how can we best take care of ourselves and our interests as sustainably as possible and from a position of strength? And there's sort of been this, thinking of a return to sort of a Monroe Doctrine, which is less reliance on the transatlantic partnership, less reliance on buying cheap stuff from Asia and shipping, all of our manufacturing base there. But it's more like, okay, let's let's maximize trade amongst our hemisphere, and let's really shore up our security weaknesses, right? You just mentioned the Canadian and Greenland Arctic borders, and whatnot. And there's
And
been talk of
Panama Canal, of course.
Panama Canal, of course, yeah,
Making sure you get across. Yeah, yeah.
yeah, and Trump has talked about borrowing the Iron Dome concept from Israel and creating the Golden Dome concept, right? Where presumably it would not just protect America, but it would protect its sphere of allies, in the Western Hemisphere as best it could. So, there is this thought of like, yeah, maybe the future really is much more hemispheric than it is global. And I'm just curious, A, your thoughts on that in general, but B, is that a message you think, and again, I hate to make you speak for your people, but that some Canadians might find attractive, like, oh, well, if we can get past the name calling and the insults, maybe we can create a trade relationship here that is long-term better for us, and we get to benefit from all these other, potential investments and protections that an American neighbor might bring.
Yes, no, I think there is a large portion of the Canadian population that may not speak up as much, but clearly would be intrigued with a much closer monetary union with the United States, not necessarily being part of the United States. I mean, that I think would take more time to get your mind around, but a closer monetary union and relationship. I mean, there's ties are very deep, and economics is what drives a lot of people. Certainly in Western Canada, you take a province like Alberta. They have not been treated very well by the rest of Canada. I mean, they have what in Canada what they call equalization payments, which is basically just socialism, where you take the wealth from one province, and if it's above a certain level, you distribute it amongst the other provinces. And Alberta has paid massive equalization payments across the country.
Because they're resource rich, correct?
Because they're resource rich, because of their oil reserves and the royalties that they collect. And they're not happy about that. If there was one province that would be susceptible to moving south of the, not moving south of the border, joining our friends south of the border yourselves, that would certainly be one. So, so the Canadian situation, it could be vulnerable. It's quite interesting. We've had a prime minister the last 10 years, Justin Trudeau, almost 10 years, who said we're a post-nation state. He ran around and said, we're just part of the global nation type of thing. We're a post-nation state, and tried to undermine the uniqueness of Canada. So that's what he spent his whole time doing. Meanwhile, you get into a little fracas with the U.S., and all of a sudden, we're Canadians, we're proud Canadians, and you sort of can't have it both ways. Either you're building a country with some patriotism and depth and breadth to its people and purpose and meaning, or you're going to be susceptible to a large country like the United States, which can offer a lot of goodies. I mean, a dollar, which is more valuable, a Bill of Rights, which is way better, a constitution that actually will give more human rights and protection to free speech and so forth. That's attractive to a lot of people in Canada. So, I think that over time, it would be interesting to see. I think Trump throws out that 51st state as a little bit of fun, right? He's just throwing that out. Where does it go? It's a trial balloon. Is he serious about it? I'm not sure, but maybe you don't know what the future has, and there might be an opportunity for again something like that. So, but right now, Canadians, I think overall, are certainly not interested in that. But a monetary union and working closely together certainly is something that we need to think about. We need to do. We need to work with other countries also. But the United States is just so big, so powerful. It's got such a deep economy, capital markets. Even if we get a change in government, Adam, we're going to need capital to come into this country, and we don't have enough capital internally to fund all of the development of our resources. And so we're going to be looking south of the border.
Pipelines aren't cheap to build.
Yeah, and we're going to say to you guys, okay, we're going to drop the regulations, we'll drop taxes, we're going to make it really attractive for you. And I think money will come back into the sector in a big way, but it's also largely going to come from the US. So we have to be honest about that.
Well, a couple things. One, I appreciate you having this detailed discussion with me, Jonathan. And it's hard to talk about these political policies that impact the economy without triggering people on either ends of the partisan spectrum. So, folks, if we triggered you, our apologies. We really are trying to do this in as nonpartisan an exploration as we can. And also just conclude on this part, Jonathan, by saying, hopefully everybody can agree that we hope when the dust settles, this ends with a better trade structure for both Canadians and Americans, and we can get past any bruises, emotional bruises, and hopefully find a path that we're mutually excited about and just execute on that going forward. Will that happen? Who knows? But I'll be here crossing my fingers for it. I was going to ask to kind of go through each of the other key pillars of the Trump economic agenda: tax cuts, deregulation, DOGE, deportations. We're not going to have time because I want to get to gold before we wrap up. Just very quickly on those four things, is there any like key strong feeling you want to share with folks?
I think each of those are very, very important. And DOGE in particular, cutting back the government. I mean, we must attack the size of government and the waste and unfortunately the fraud that's been taking place. It is substantial. And if we're going to meet our obligations as countries, I mean, speaking here as a Canadian and yourself as American, we're going to meet our obligations to look after vulnerable people. We have to do that from a strong base, and we need to be truly looking after the real people in need and not paying people that are taking advantage of the system. And I think deportations, I know they get into the price of labor and so forth, but you know what the U.S. has allowed the last number of years in your country where people just break into the country, and you know that's basically they're actually not even breaking in because it wasn't necessarily illegal in one sense, it wasn't being enforced, is incredibly dangerous. And if you don't have borders, you don't have a country. This is one of the reasons why I think the Trump administration is trying to bolster North America or the Western Hemisphere, if you will, is because in Europe, I mean, this is, you know, again, we'll just throw this out. It's a big topic. But I think they're very concerned with the shift of Western Europe, the fact that they don't share the same values now as the United States as much, you know, in terms of free speech and free markets. And you've had a tremendous change in cultural influence in some of those countries. And that also presents some risks. And I think Donald Trump is also worried about some of the shifts in Canada if we're going to have a safe nation. So you can't have countries unless you have unified beliefs, policies, understandings of the economy, people working together, people that love their country. Otherwise, you're going to have disunity and disharmony, and that's a major problem. Also, as we're looking at Europe and in Canada, we need to really change some of our immigration policies and make sure we've got people who actually want to be here, want to contribute, and love the country, and are not trying to take it apart.
Yeah, good points. And I just should note on the day we're talking, looks like the French courts have just declared that Marine Le Pen, who is
Yeah.
the leading candidate right now in the French elections for prime minister, is not allowed to run. And that is kicking up a lot of additional concern about overreach and intervention and suppression of true democracy and whatnot. So we'll leave that for now, but there
Yeah.
may be a lot more to follow up on that point in future
Just
months.
yeah, just one very quick comment. Just remember what JD Vance, your vice president, who I think is a great vice president, what his comments just early on as he went over to Europe and just talked about his concerns, the administration's concerns with free speech in Europe and so forth. So these are, I think, real concerns, and so we better pick our friends and work together and protect our freedoms and liberties and not take these for granted.
Okay. All right. Well, look, let's switch here now and give gold its due here. So I've been interviewing you for a number of years, Jonathan. I know that you have long concluded that gold was likely undervalued and would likely catch a bid at some point here. Certainly that's what's happened, I'd say, in the past 6 months. I think I read somewhere, I'm doing this from memory, but is gold up something like 70% in the past 16 months?
Yeah, it would be close to that. It would be close to that. Yeah, I don't have the exact number, but it's staggering how it just continues just to move north, and then over time how that aggregates into a large number. I mean, I was just thinking here when back in when I started Rocklinc 2010, we bought a fair chunk of gold, but in Canadian dollar terms, you were buying it because our dollar was actually higher than the US dollar at the time. We were buying it about $1,100 Canadian, and now it's trading at $4,500 Canadian, and that's in about 14 years. So you've got, pretty close to a quadruple on just buying gold bullion, let alone buying, potentially stocks. It's a phenomenal change in price. And I think, as some people pointed out, if you actually go back to 2000, gold has actually outperformed the S&P 500, which I think is pretty shocking to people.
Yeah, yeah. All right. So I guess I've had a number of people on the program where we've dedicated the discussion to what's driving gold here. Folks, you want to see the latest one, go see the video with Andy Schectman. But in your mind, Jonathan, what do you see as the key drivers for the big move that gold has had recently?
Yeah, we go back to, one of the reasons why we started building positions, and it only gets more intense, and that's just the global debt. I mean, just the tremendous buildup of global debt and the pressure on fiat currencies and the print, as a result, the printing of money and the increase in the money supply over the last number of years. Now you overlay that with uncertainty, the tariffs, a change in the economic model of the world, along with central banks purchasing, I think, to bolster their balance sheets, and pressure again on the U.S. Reserve currency. I mean, you start to put all of those together, and I think it becomes a really a great picture for gold, as people looking to it as a place to hedge, a place to protect value. And so I think that in a nutshell, those would be the key drivers from our perspective.
Okay, so gold is having its time in the sun right now. Where it goes from here, who knows? If you have any strong feelings one way or the other, please let us know. But how are you at Rocklinc playing that? Is it more through the metal itself, or is it more through selecting what you think are the best companies to benefit from a rising gold price that you put in your portfolio and watch really closely? And I happen to know that you really like the streamers and the royalty companies.
Yeah, so we have a small amount in gold itself, the bullion, and you can buy that. We have a number of clients who actually buy from some of the gold storage companies, and they'll store their gold. That's a relatively small amount of our gold purchase. We generally like the royalty companies, and so you go back to 1990s. Just a fascinating story for you and for the people listening. Back in 1990s, when I was running the AIC funds. I was one of the key portfolio managers and president of that company. We became the largest institutional shareholders of Franco-Nevada. We also owned a lot of Euro-Nevada. That was a sister company. Franco run by Seymour Schulich, and Euro-Nevada run by Pierre Lassonde. But those are the two partners. And, Pierre is still very active in the gold market and brilliant investor. But I remember going up to their place. We were large investors, and we bought Franco and Euro largely because they're cash flow vehicles off of the gold market. They're investment bankers, and so they invest in many mines, and then they get a royalty, whether it's a smeltering return or a royalty, and more recently streaming. And there's some nuances to those, but basically you're getting a cash flow off the production of the miners. But I remember going up, and this was in the year 2000, going up to visit Seymour Schulich at his office in Toronto, downtown Toronto. And this was before they sold the company to Newmont and cashed out. And then Newmont spun it back out again. And I remember going up to this relatively small office, beautiful office, but nothing very large. And there was, maybe 10 people, dozen people in the office, and him looking around and says, "Jonathan, can you believe it? This is worth almost $3 billion. This little office here, a few people we have in this place." And I thought to myself, what a business model. You can't beat the business model of the royalty companies. And he said, there's where all the checks come. There was an inbox on a secretary's desk because, of course, you didn't have the internet, and money didn't move that way. He says, the checks just come in here month after month after month. And so I really just love that the royalty story, and we got associated with it through Seymour Schulich and Pierre Lassonde way back when, and so I just love that model. And so whenever I got concerned about the financial markets, I go back and say, okay, can we find royalty companies streaming companies that can make lots of money, are well positioned, have diversified portfolios, and generate the cash flow. I'll tell you just one other, just very quick story. I had a meeting with Peter Monk. Again, he's the founder of Barrick. Okay, so a legend up here in Canada for many years. He's passed away a few years ago, and he was running a company called Trizac Han, which is a real estate company. And I went in to see him and talk with him and about the real estate company. He was raising capital in Toronto. And I said to him, I said, what do you think of Franco-Nevada? And he said, and I'll edit some of his words. He said, "Those buggers." He said, "They made more money off of our mines than we did." And so again, those things stick in my mind. That a lot of times the royalty companies are really where the game is. They're safer, and so that's what we've done. So our big positions there are Franco-Nevada, Wheaton Precious Metals. We have some in Royal Gold, Osisko Royalties. And then we have smaller positions in Gold Royalty and Vox, Vox Royalties. Those are smaller ones that are trading at very large discounts to net asset value. And a little bit in Sandstorm also. So we have a handful of those companies, and they comprise currently, now they've gone up in value, about 20% of our portfolio. So we have a large stake. There's not very many asset managers who would have that kind of stake in that sector. And again, we have that position simply because of the factors I talked about before. The world is really going through some big changes, and we want to be hedged into businesses that can create cash flow off of the gold and silver prices. And some of these guys also have exposure to copper and to the oil and gas market also. Yeah.
Okay, so so they're good cash flow producers, which, as we talked about earlier, if you're expecting this year might be kind of a stormy year, great to hold an asset that's just still paying you every month, right, and bringing the cash flow in dependably. Now, the cash flow prospects for these companies presumably should be really bright, right? So just for folks that maybe aren't totally familiar with the term royalty, but essentially what a royalty company is you said it's like an investment bank where they will oftentimes provide funding to a mining company to help them finance, building the mine, digging the actual ore out of the ground, et cetera. And as payment, they take a future stream of profits, basically, right? So the royalty company isn't exposed to the cost structure of the mine going forward, whether labor costs go up, energy costs go up, whatever. The royalty company doesn't have to worry about that. All they know is that, hey, we get X% of the profits that are coming out of this mine every year, or the profits on the ore, the ore sales themselves, right? So
and they have margins that are 95% margins.
Right, because they have almost no costs, right? So as the price of the ore that gets sold that they have a share of goes up, it's pretty much all profit to them. And the price of the ore has moved a lot in recent quarters, right? So are those stocks yet reflecting that bump up in profit that they're seeing?
Yes, and the other factor to point to also, we'll just talk about stock moves in a second there, is that they have organic growth too. So if you look at Osisko Royalties, for example, they have embedded already, if they just went to sleep and didn't do any more work, they've got royalties that will be coming on stream through different mining projects that are going to give them 8 to 10% volume growth. So even if the price of gold stayed the same, conceivably, they should actually be growing their earnings by at least 8%. Now,
because of deals they have in the pipeline that are coming online?
Exactly. So these are growing businesses. If you take Gold Royalty, which is a smaller one, they're actually growing at about 50% a year over the next 5-6 years, coming off a smaller base. Sandstorm's also growing at high single digits, and even Wheaton Precious Metals, which is a very large company. Now you're talking a $40 billion plus company. They've got organic growth just in their deals that are already inked, worked on, of 8 to 10%. So then you add that on top of that, you can add the price increase of the underlying commodities. So that's why we say you're profiting from gold and silver, but now you're buying a business that can compound on the back of the increasing price of gold and silver, which is wonderful. Have the prices reflected? Yeah, to a certain degree, we've had a nice little increase in price. I think that Franco-Nevada, Wheaton Precious Metals, those would be trading at about 2.5 times net asset value, which I think is closer to being fully valued. So now any move, I think, is going to be based on the underlying commodity. Sandstorm is trading closer to net asset value. So there's an opportunity for a larger uptick in the value of that business as people get more confident and comfortable with what is taking place there. They've added a number of and took on some debt, and that concerned the market, but now they're paying down all that debt. And a Cisco trades about halfway between about 1.5 times net asset value. So they also could get an uptick in the multiple. So what you're trying to do is find companies that are trading at lower multiples that can get re-rated to a higher multiple value. And Gold Royalty, Vox Royalty, some of the smaller ones, I think, again, could get a re-rating as they continue to grow and execute. So the big guys, I'd say, yeah, they're going to track more the price of the underlying commodity. So if you're bullish, they'll continue to do well and protect your value. But they're trading a little bit, closer to high valuations. We also have a couple miners. We don't have a lot, but we have Agnico Eagle is an exceptional. I mean, Sean Boyd, the CEO there, has just done one of the most amazing jobs over the last couple of decades. It's just shocking when you invest with him versus the other large players. We won't talk about them, but I mean it's just night and day. You're talking about 1,000% difference in return. But that's a powerful company, well positioned, continues to do deals, and I think it will, can continue to grow very quickly. Pan American Silver also we own, Mag Silver. So we do have a couple of miners. Some of our clients like to own few of the miners, and then we try to ferret out some of the very best. But they understand whenever you have a miner, you're going to have more risk, more volatility, and you could have a political problem or a mine blows up or something. Again, you can have mine-specific issues that are out of our control, and that could come back and bite a miner much more than a royalty company, which is so much more diversified, has so many more streams of revenue coming in from so many different mines, different countries, and you get that diversification, which gives you a lot more safety.
Okay. Just because we're talking on the subject of gold here, I just want to remind folks, if you haven't checked out Thoughtful Money's new free guide to buying and storing gold and silver, that's available for free to be read at thoughtfulmoney.com/gold. And that just kind of walks you through a lot of the different options out there, everything from, owning physical silver that you have shipped to your home and you hold in your own hands, versus remote storage operations, versus some of the paper gold instruments, versus some of these mining companies and streamers that we're talking about, royalty companies. All right. So Jonathan, we got to start wrapping up here time-wise, but on the gold topic and specifically Rocklinc's process for investing in them, is there anything else you want to let folks know about before we start to wrap up?
I think the only other thing I would say is that we have had a large run in the gold, so just be patient and careful. The tariff situation, I think, is pushing it maybe a little bit even faster. So it doesn't mean the price of gold can't come back down a little bit. And so, again, you've got to take a longer term view and be disciplined. I do think that the overall global macroeconomic situation is basically intractable and it's going to be very difficult to extricate ourselves. And so I think gold has a lot more life to it, but that can come in fits and starts. So be patient and be very careful if you're buying junior mining companies. You really have to know what you're doing. Be very careful. These you can hear, they're amazing storytellers. The CEOs can spin all sorts of wonderful stories, but they are risky. So if you're going to go into that sector, either go into an ETF where you can get a little more diversification, or follow very, very good people. I know, Adam, you've got some exceptional people that are in that space a bit more. Someone like Rick Rule also knows that, but be very careful. Please don't go in on your own and just listen to rumors or someone on the internet telling you to buy, unless they are really experienced individuals. You can lose a lot of money and very quickly. It can be very depressing. You do not want to do that. You need to protect your capital and grow it.
Very well said. So yeah, if you want to invest in the mining space, especially in the lower tranches, the juniors like Jonathan's talking about, unless you already have a ton of experience doing that yourself, which really few people do, I think you should leverage a professional. And so either a professional like Jonathan and his firm to manage the best basket that they can put together for you, and they're watching it like hawks and they're determining when to get in and get out and whatnot. Or if you still want to be a DIY investor, leverage the expertise of somebody who's been following this industry for decades, and the good guys have been doing it for decades. And these are folks that, publish newsletters. They're very transparent about,
Mhm.
which companies are on their watch list, which ones aren't. And you can basically look over their shoulder and follow their trades, see what they're buying, what they're selling, why, and just, kind of take an apprentice copycat strategy with those folks. But there, your goal is to not try to find the next best mining stock to buy. It's to try to find the best mining stock expert whose advice you want to follow. And you're right. Rick Roll's a great guy. Rick publishes these boot camps periodically. I don't think Rick publishes any sort of ongoing newsletter or whatnot on it, but he does do the boot camps and his conferences. And uh, Jeff Clark, who folks have seen on this program in the past, he's one of those guys who's been in the business for a long time. His business, I think, is called the Gold Advisor, and you can check that out, folks, if you want to. All right, so just beginning to end here, Jonathan, a lot of people are probably watching after having peaked at their portfolio balances and probably feeling a little bit of sting after the past month. The headlines, at least here in the States, sounds like maybe the same is true up in Canada, are now all of a sudden worried again about recession odds. Um, what's your what's your advice for stressed investors right now? And maybe I'll preface this too by saying, as you know, Thoughtful Money tries to connect people with helpful resources like financial advisors who see the world like many of the guests who appear on this channel do, and you're the endorsed one for Canada. I, I, I see the referrals that get made off to these financial advisors, and for whatever reason, Canadians are very underrepresented in those referrals based upon the percentage I know who watch this channel. And so I'm wondering if there's something about Canadians that just makes them a little bit more gun shy or whatever about working with financial advisors. But certainly there's a high level of stress. I hear it from Canadians that watch this channel. So what would your advice be to people who are trying to navigate a scary year, both portfolio wise and like, I might even lose my job this year?
Yeah, which is a real issue. You mentioned losing jobs. I mean, we do have a higher unemployment rate in Canada, and it's been stubbornly higher. And I think with some of the tariffs, especially in Ontario, I think there's a lot of concern, especially in the auto sector. I mean, this is a very important sector to Ontario, and there's no question Donald Trump wants to pull some of that back into the U.S. And so I think we're feeling that. Look, I think the key from our perspective and from the way I look at the market and what allows me to sleep at night is you have to know what you own. You have to know what you own and why you own it. So as professionals, we will study the companies, understand the businesses, put valuations on them, and you have to know your time horizons. You cannot again, you should not be in the stock market if you can't be there for the next 2 years or so. Should not be in the stock market if you can't take a 30-40% reduction in the value of your securities. I mean, these are things that people must be very concerned, be very careful about. So from our perspective, what I tell people to do is look at your investments, what's your time horizon, identify assets that fit your time horizon, and then invest in quality and know why you're buying them, and have adequate diversification across a number of businesses. So that's largely what we're doing. We're carrying a little extra cash. We're staying away from certain industries that we think are more vulnerable to tariffs and a slowdown in the economy, putting our money into other sectors which are largely recession proof, as much as any businesses are, and then looking for downticks in the market to buy companies that we'd like to own that we can't own. So I think a lot of it's just knowledge, patience, and discipline, and understanding your time horizons. We'll have clients phone up and they've got a lot of money, and they'll be concerned about the market. We'll say, listen, you've got lots of capital. You've got capital for the next 8 years that you could siphon off, and you wouldn't even, wouldn't even have an impact on your financials. So, why are you worrying about the volatility? If people are really close to the wire, they need to really be careful about the volatility and make sure the quality's there, and they don't take any downstrokes. So I think it depends on the person, but a lot of it gets back to quality, understanding what you're buying and why you're buying it, and what your time horizon is, and being patient.
All right. Well, very well said, Jonathan. All right, folks. Well, look, in wrapping up, first off, if you enjoyed this conversation with Jonathan, want to thank him for being so generous with not only his knowledge, but also kind of sticking his neck out there and opining, on the in the political policy world, which, like I said earlier, I know can be sensitive for a lot of people. So thank you, Jonathan. But to thank him for that, and if you'd like to see him come back on again the channel soon, please let him know by hitting the like button, then clicking on the subscribe button below, as well as that little bell icon right next to it. And if you are feeling undue stress about where things are headed, especially regarding your wealth, and would like to benefit from a free consultation with one of the financial advisory firms that Thoughtful Money endorses, perhaps Jonathan and his team there at Rocklinc, if you live there in Canada, then you can schedule one of those free consultations by filling out the short form at thoughtfulmoney.com. And if you're Canadian, make sure you select Canada as your country, and then you'll be matched with Jonathan and his team. But once you fill out that form, the firms will reach out to you right away. And as a reminder, these consultations are totally free. There's no commitment to work with these firms. It's just a free public service they offer to help as many people as possible. Jonathan, it was wonderful. Again, I want to thank you both for the discussion today, but also for your long-term partnership in supporting all the people that we send your way with questions and trying to help them navigate this very complicated macro environment we have ahead. I'll let you have the last word here as we wrap up.
Yeah, I would just say in terms of the Canadian investors, we'd love to hear from you. Reach out to us. It is free. We love to meet the different people, and you can learn more about our business and how we would manage your money for you. It's a real privilege. I got some great guys working with me. They love the business, and we love the challenge. And so I just encourage people, again, look beyond the next couple of days. We've got that Liberation Day coming for the United States in a couple of days, but look beyond that. I think all of this too will end at some point, and I hope that rational heads will prevail. And I think by and large, most of the policies that are being put into place are good long-term policies for economic growth. And what the Trump administration is doing is putting a lot more pressure on the world to shape up also. So you can't just lower tax rates and regulations in one country. It's causing other countries to reevaluate what they're doing, and I think that's positive. We've been going way too far over left, and we need to pull back right in terms of a lot of these policies. So I think actually, if we can just weather the next little while and have strong stomachs and be disciplined, there could be a lot more light at the end of the tunnel than people think.
All right. And as an investor, obviously, I assume that makes you excited that if those policies indeed actually do start spurring economic growth, there'll be some great investing opportunities along the way.
Absolutely. Absolutely.
All right. Well, thanks so much. You mentioned your team. I do just want to commend you, Jonathan. You built a great team there. It's a total stereotype, at least here in the US, how nice Canadians are. But I really can't say what a pleasure and really just sort of how nice your team is to work with.
Well, we don't want to disappoint anybody. Canadians, by and large, are wonderful people, and so we try to exemplify that. But they love the business and the great guys, and we love working with the clients. So call us, reach out to us anytime.
All right. Well, Jonathan, thanks so much. Everybody else, thanks so much for watching.